Okay, so section 3 is strategies for saving and investing. So we're going to talk about the concept of systematic saving and investing, describe how you can lower your investment risk through diversifying and building an investment portfolio, and how you can maximize your investment return by understanding the financial marketplace and the economy. Okay, so what are systematic saving and investing strategies? So, systematic saving is a strategy that involves regularly setting aside cash that can be used to achieve goals. The amount should be the most you are comfortable to afford to save each pay period. And sometimes it may be convenient to have it automatically come out of your paycheck so that it's just done for you. You don't have to worry about it. You could do a monthly payment to a savings plan if that's what you prefer, rather than every paycheck. Most people get paid more than once a month. But that systematic savings should stay in that savings account until you reach your goal. Maybe your goal is to go on vacation, and once you save that money for your vacation, you take that money out. If it is just your emergency fund, that's a little bit different. But once you have your savings built up so that you have your emergency fund, your daily expenses, your short-term goals, those are all met, that's when you should begin investing. And systematic investing is a strategy that involves a planned approach to making investments on a regular basis. When you first start investing, you may want to buy safe and liquid investments. Remember, liquid meaning you can turn them into cash quickly if needed. In later years, you may want to take more risks. Remember, the higher the risk, the higher potential return. Investing doesn't always mean making more money. And I say that as I started reading some of your homework answers from last week. That's the idea, and in a perfect world, but sometimes with investing, you are going to lose money. Keep that in mind. But a systematic saving and investing plan, those are long-term focused. They are not something that you're just going to do for 6 months and kind of call it a day and move on. Sometimes as an investor, you need to hold on to the investment for 20 or more years to get the returns that you want. Obviously, everyone's goals are different, but just know that these are built with the idea of long-term goals. All right. Investment tracking is a technique for making investment choices by following the prices of stocks and other investments over time. So you can look at stock prices online. You can track them in different newspapers. If there's a certain stock you're interested in, you can kind of follow it to see what's going on before you jump in if you want. So by tracking it, you can see if you're happy with their performance before you get invested in it. Oftentimes people keep charts or graphs of some sort to kind of follow along, and we'll see that on the next slide. Market timing, we've talked about a little bit, is buying and selling stocks based on what the market is expected to do. So if you have a good understanding of the economy and general conditions of the financial market, those tend to kind of lead to good investment choices, understanding what's going on. So stockbrokers and there's analysts that's their job to kind of pay attention to trends and what's happening and make those predictions for you. And so people with those jobs are able to give advice to their clients on what they predict is going to happen. But it should be noted, market timing is risky and can be difficult. Yes, there are trends and sometimes patterns, but it doesn't always happen that way. Everything in the world is not predictable. And so They can say what they think is going to happen, but that might not actually happen. So this is a stock trend line. So it shows the changes in the price of a stock over a period of 12 years. And so again, if you're looking in the long run, this is making money. So stocks are often a long-term investment. Some people do day trades and things like that. But overall, this stock has done well. But if you looked at this in 5 years and panicked and sold, after 5 years, it's what, around $46 maybe? And so you'd be losing money. But if you just held on to it and kept going, then it goes up. So just because you aren't doing well at one snapshot doesn't mean the stock isn't going to do well. All right, and then the other strategy is dollar cost averaging, which is investing the same amount of money on a regular basis regardless of market conditions. So you could say, you know, every paycheck I'm going to invest $50. Every month I'm going to invest $200. It doesn't matter if the market is high or low, you put that much money into your investments regardless of what's going on. All right, so how can you reduce investment risk? So diversification is holding a variety of investments for the purpose of reducing overall risk. If one type of investment goes down in value, the others may go up. So a loss in one area could be offset by a gain in another one. So there was like a saying, having all your eggs in one basket. Same kind of idea. You don't want to put all of your investments into just one thing, because if that one thing tanks, then you are out of that money. You also want to build a portfolio, which is a collection of investments. Again, you want that portfolio to be diversified. So this is an image from your book, Portfolio Diversification. So you want to start kind of at the bottom with a strong foundation. That's why it's the biggest. It gives examples over there on the right. I don't know how much. That's what we're really going to focus on chapter 11 is like safe or low risk, medium risk, and high risk. So we'll kind of go through more of these. But you build that strong foundation there. They can be your savings account, your CDs, your treasury bills. And then going up, you have your conservative investments, your growth investments, and then your speculative investments. And again, it gives different examples over there on the right. So those speculative investments have high earning potentials, but carry the highest risk. So again, as it goes up, your risk goes up as well. So how can you maximize your investment return? So the financial market is any place where investments are bought and sold. So if you understand the economy and how it affects the financial market, that can help you make better financial decisions. There's always periods of growth and decline in the financial market, which lead to bull and bear markets. So a bull market is a prolonged period of rising stock prices and general feeling of investor optimism. If you think the market is going to continue to rise, that is a good time you may want to buy stocks for some investors. Other investors choose to sell during a bull market. They think things are going up, and maybe they bought when it was lower, so they made a profit. So again, different people have different perspectives on this, and so you need to figure out if this is something you're going to get into, which one kind of best fits your needs. Some people invest on their own, some people hire somebody. If you are hiring somebody, I recommend kind of understanding how they feel and if it matches up with what you feel and what you believe in. And a bear market, on the other hand, is a period of steadily decreasing stock prices and investor pessimism. So some stocks may fall very quickly. And then some people will then take their money out of that market because they get scared. And some people at that time decide that's when they're going to buy stocks because prices are lower than normal. Bear markets are usually very short, but your book says short and savage, meaning there's often big losses in that short amount of time. A bull market is typically 3 to 5 times longer than a bear market. So some bull markets are a few months and some are several years, but those bear markets are much shorter. All right, and that is it on our slides, but we're gonna do the math real quick. Okay. Sorry, I'm gonna try to get it all set up here so you can see the book and my paper. Okay, so there it is. All right, so number one, John bought stock for $350. A year later, he sold it for $385. I'm gonna try to actually fit this the other way, sorry. What is his gain in dollars and what is his return on investment? There we go. Okay, so he bought it for $350, sold it for $385. So what is his gain in dollars? So 385 minus 350 is $35. And then his return on investment, remember we wrote that formula down. Well, it was in our notes. You may or may not have written it down the other day. But it is the profit divided by the amount invested. All right, so the return on investment here, we're often going to call this the ROI. I'm not going to write return on investment. Again, that was the one and only time. Again, it is the amount we made, the profit, divided by the amount of money put in. So John paid $350. All right, so 35 divided by 350 is 0.1, which is a 10% return on investment. Again, calculating the return on investment as a percentage is nice because say you made $45 on something else, but you invested $1,000 in it. Well, if you can compare it as a percentage, then you know what one was the better investment because you don't always put the same amount into different investments. All right, number two, Samantha sold her collection of model cars for $600. She had purchased them for $520 a year earlier. What is her gain in dollars and what is her return on investment? Round it to the nearest whole percent. All right, so her gain, she sold it for 600, but she bought it for 520. So Samantha made $80 here. So her ROI, return on investment, we're going to take that $80 and divide it by the 520 that she put in. So 80 divided by 520 is about 0.153. Actually, that should be a 4, not a 3, if I'm rounding. Because after the 3 is an 8. But really, I don't even want that because the book says round to the nearest whole percent. So about 0.15, which is 15%. And finally, number 3, it's a little bit more complicated. Pedro bought 25 shares of stock for $150 a share. He received dividends of $3 per share each year for 5 years. After 5 years, he sold the stock for $155 a share. What is his gain in dollars? And what is his return on investment? So the first thing we need to figure out is the purchase price. How much money did Pedro spend? Well, he bought 25 shares at $150 a share. So $150 times 25 shares. So Pedro put in $3,750. That was his purchase price. That's how much came out of his bank account. Okay. He received dividends of $3 per share each year for 5 years. Okay, so $3 per share. So $3 times 25 shares each year for 5 years. So times 5 years. So in case it helps you, there's 25 shares and 5 years. You don't have to write that down in case, but if you wanted to look back over this, in case there's something like this on your test. All right, so $3 per share, 25 shares, 5 years. So his dividends are $375. All right, he sold the stock for $155 per share. So the sell price oh, 25 shares at $155 each. $3,875. Okay, so a couple of things before. So we need to get the gain in dollars and the return on investment. So the gain in dollars, he's making money 2 ways here. He's making money from the dividends and from selling the stock. He didn't make $3,875 when he sold this stock because he spent $3,750 to buy it. So an increase in value or capital gains. So 3,875 minus how much he spent. So Pedro made $125 from selling the stock. So his gain then is 125 from selling it plus the 375 in dividends is $500. So in 5 years, Pedro made $500 here. So his ROI is the 500 he made divided by the amount of money he spent to buy it. So the $3,750. So 500 divided by 3,750 is about 0.13 or 13%. Sorry, move that out of the way. Any questions on that math? Okay. So, your homework tonight is section 10.3 from the book. I think there are 12 questions again, the multiple choice, and then 3 or 4 free response. Tomorrow's homework is the vocab worksheet. I may or may not remind you of that tomorrow because we'll be focused on our test. You just know that it's due on Friday. If you want to do it tonight, fine. If you want to do it on Thursday night, fine. If you want to do it on Saturday, also fine. Remember, as long as you get it all in by Sunday night, besides your test, which that's your Friday assignment, and that's how I will take attendance. But that is it for today. If you have questions, maybe you're confused about the test, maybe you have your own computer